Morning, everybody. Today is October 10th. I'm recording this before today's market opens. Wanted to look at Monday's price action after the extraordinary terrorist events we saw in Israel on Saturday. We're going to be a little bit quick today. We're just going to hit the highlights. I just want to see if there's any immediate action we need to take with portfolios as we start this week. So let's begin here with how did markets open on Monday morning? So you would expect after significant terrorist activity, like we saw, that you would see defense contractors doing very well, 5.63% one-day return on Monday. Energy services, and oil and gas all up between 4 and 3, or almost 5% and 3.5%. U.S. stocks kind of tepid around 1%, actually under 1%. Gold up 1%, and the 10-year yield was up 27 basis points, so basically flat on the day. Not all that surprising given the activity, the terrorist activity that we saw in Israel. So with regard to the VIX, did the VIX break out? Did we see a huge move in the VIX? Well, we really didn't. We just saw it kind of in that same range that it was in last week, except for this little peak. But we did not see any type of activity pushing the VIX to any extreme levels. So that is a positive for the market. Gold volatility during COVID, we saw a pretty good spike a little bit here during the beginning of the Russian invasion of Ukraine. Today, not so much. No real pop in gold volatility. Crude oil volatility, we've already looked at the price, the one-day price. Crude was really weak last week. Spiked during COVID, spiked during the Russian invasion, and yesterday nothing is really screaming. There was, if we draw a line from down here, we do see it is a little bit higher, but we're certainly well within the recent range for crude oil. So it would, as of this morning, as a pre-market on Tuesday, I would say that there's nothing that's earth-shattering going on in the oil space as a result of the terrorist activity. Here's a little bit closer look in gold. This is just going back to July of 23, where we see we've kind of been in this range. That range broke down, and here we are. This is after Monday's close. Certainly a large gap up. Maybe that gap fills later today. I don't know. We'll have to see. Let's take a look out further and see what that would take, or what that would look like. And if we go back here, this is 2009, Great Recession, and this huge base that took place from, what are we looking here, mid 2011 to end of 2021. And we were looking at this cup and saucer. If we sort of draw a line here, and we got this handle, and anticipating this breakout here, which we never got. We've come down. Let me clean this up a little bit. We've come down into this channel in gold. It's broken out. Never been able to get above this high, and here we are. Okay, so when we look at this chart, we say, hey, look at that gap up. That's a pretty good move in gold. Here is as the map would say, in the shopping mall or the amusement park, this is where you are right now, and I wouldn't say that that's a robust move. The Wilshire 5000, so this is a very broad domestic stock index. It's actually not 5,000 stocks, it's closer to like 3,800 stocks, but coming out of the low here in October of last year, we kind of held this this trend line. Maybe we'll continue. Maybe we'll see this this little pause, or in September rather. Will we be rewarded with the breakout? Is this going to break down? We'll find out. But we did not wake up to a sort of an emotional response in the market where we plummeted further lower off of this action. We kind of pulled down to a logical area that looks like it's acting as support. And, I think that this week we'll see whether we confirm and go higher, or whether we do roll over. But as of right now, as of Tuesday morning, the Wilshire 5000 looks just fine. The value line index. This is the average U.S. stock, and the average U.S. stock hasn't done a whole heck of a lot. We're down here looking at June of 21. Sorry, let me get my marker up. And we're in this space, and we haven't really budged. Looking back, if you've been keeping score at home, you've noticed small and mid caps have lagged. The mega caps have been ruling the day of late. The average stock was up just a kiss, but kind of holding in line with where it had been recently, and there's no shock. There was no shock to the system for the average stock after the terrorist attack. US dollar has been a nemesis to stocks of late. That is for sure. And this strong move that we see right here, that has created some problems in September for U.S. stocks, to be sure. But we do have this little, is this, a significant move? Is this a trend line? I don't know. What we didn't do is, again, we didn't wake up Monday morning and see the dollar crater. We didn't wake up Monday morning and see a huge move this way. Dollar was pretty much flat. There's some upper wicks here, but there wasn't a whole lot of activity. And a quiet dollar, if it's not going to be, falling quickly, a quiet dollar is a dollar I'll take right now. And when we look at the impact that the dollar has had on stocks, when the dollar has been ripping, stocks have not. And that relationship has carried itself, as we see in these pivots. When the dollar was pulling back, the dollar was pulling back, equities had a chance to run. We have another pivot here, stocks take off. Then, this pivot there, stocks pulling back. So hopefully the dollar can reverse, break through this this point of interest here, and we can get a bid in stocks again for the fourth quarter. That would be fantastic. But again, for the purpose of this analysis, we're looking, did Monday change the relationship between stocks and the dollar? We're close. Okay, we've got this action here, and we can say, we're closer than we were a couple of weeks ago. Hopefully we get follow through, and this continues where stocks can go this way and the dollar can go that way. Okay, so regarding stocks versus bonds, here is the 30-year Treasury price versus stocks. Okay, so when we see this chart heading down, and let me get this up, when we see it heading down in this direction, it is telling us that stocks are in control. And while there have been a few spikes of fear, which goes back to 2007, generally speaking, stocks have been the show. And again, we wake up and that has not reversed yet. Now, bond markets were closed on Monday, so we're not going to necessarily see a big reversal up or a big reversal down, but there's a pretty strong trend here. Now, if you notice, these are crisis events. These aren't good times in the market when we see these spikes, and it's very calm right now. So is this going to be the catalyst? Is this event going to be the catalyst that reverses this chart? I don't know. We have to see. But as of right now, this would be a chart that confirms equity strength, and one that we'd be looking at as a positive towards kind of holding our current relationship between risk on and risk off assets. A ratio between wants versus needs, or consumer discretionary versus consumer staples. This relationship has not changed. Maybe you could argue there's a little bit of a consolidation here as it kind of moves off a little bit in this direction, but this looks very much like it's in the discretionary or the wants camp. Growth versus value, same thing coming out of the start of the year. Growth reversed course. We were in sort of a value camp, and then growth took off. We've had a couple little healthy pullbacks. We've got this little consolidation, and we are on the top of this consolidation box. Are we going to break out? Is this going to head up this way? Time will tell. But again, Monday morning did not reverse this. Monday morning did not break even that very steep trend line right there. So this is still confirmed for growth. It's really, really important that we remember that we're not invested in a product. We're not invested in an investment. We're invested in a process. And that process is trying to identify the price relationships between various asset classes in the marketplace to help us understand how to position our funds for the best opportunity to make money. Okay, so this isn't about the news cycle. This isn't about the fear. This isn't about the news and the people who we may not care for very much, or the people we may care for very much. Okay, all that emotion has to be put aside, and we have to focus on the process. And that process is derived from price. We aren't. I'm not waiting for a press conference. I'm not waiting for someone to get up and say something. I'm waiting to see how price responds to those things, and then we can allocate accordingly. At the end of the day, what governs everything else in these decisions is your plan, how we're structured personally for you, so that we can take advantage of the opportunities and avoid the pitfalls as best we can in these types of in-market environments. So please feel free to reach out. My number is right here. Happy to go through any of this information or your specific questions if you have a problem or a concern. And these aren't the funnest days, but there is a plan in place. There's a process to adapt as things change. They are always changing, and we're going to do our best to stay abreast and on top of things. Feel free to, again, to reach out, and have a great rest of the week. Take care. Bye.